Day 6 of an equity market rally underway right now, leading some to go back to original thesis and question whether the death of the U.S. economic recovery has been greatly exaggerated. Well, that's what Morgan Stanley's head of fixed income, Greg Peters, says, at least. He joins us now live. Greg, we were talking about, the U.S. Treasury market and such pressure on yields. Right now, we're at 308. We're seeing a bounce back up there. What has changed here about the overall thesis about the global recovery, and why are you more optimistic?
Well, it's not that we're more optimistic, actually, as our views are actually largely unchanged from the beginning of this year, as we felt the first half would be stronger than the second half. We're labeling it the triple B recovery, so bumpy, brittle, and below par. And that's precisely what's happening. It's just the market has really turned and really taken the data on the heels of everything that's happening in Europe and just has taken it much more negatively.
Now, we've seen the yield on the 10-year moving up here, but traders are adding to their inflation bets at this point. I mean, given where we are now, what do? Go out and do you buy tips? I mean, have we moved from concerns about deflation to inflation?
I mean, it's been absolutely astounding what's happened this year. So, as you may know, we've had a call for the balance of this year for much higher rates. That's obviously not happening. But what's happened is that there's been so much concern about deflation. So you saw tip break-evens really come collapsing down, and that's just starting to renormalize. So what I think the market action over the past couple weeks and even month or so leading up to this week has been much too negative, and that's manifests itself not only in yields but break-evens, and I think you're just seeing some kind of normalcy finally set in.
Is there a question out there about the level of perhaps indigestion that we might experience given the auctions that we are expecting this week? Yesterday, $35 billion of 3-year notes. Today, $21 billion of 10 years, $13 billion on 30 years tomorrow. What level of demand is still out there?
It seems it's quite robust. So we've had a fantastic auction thus far. And then all the concerns that we have, digesting the supply on the auction front definitely is not one of them.
Now, yet, we're still 10 days away from getting the results of those European stress tests on their banking system. I mean, do you believe that the stress tests, as currently structured, are stressful enough?
We do, and so one of the central tenets of our core thesis has really been three to be more constructive. One is that we've been fading the double dip. Two is that we felt like there's a greater probability around the efficacy of these stress tests, and then third is just the global economy and then specifically China actually holding in quite strong. So on the stress test side, that's something that we do put some faith into. We feel like that is the proper roadmap. Obviously, the devil's in the details, and most importantly is the execution around the capital injection. But I feel, on balance, I feel pretty constructive that finally in Europe we're getting to a point where we're not ahead of the curve, but we're not far behind it from an ECB policy standpoint in dealing with this problem.
Moody's announcement today, sort of following on the path of S&P as to its concerns about Portugal's debt. Yet we're seeing some demand out there for Greek debt in that recent bond auction. I mean, how do you make sense of those two notes?
Well, I mean, my gosh, if you ever thought that the agencies that are lagging indicator, today's news was it. And the market's well past that, well past that, and they're looking towards the austerity programs, they're looking towards the stress tests. So honestly, the news out of Moody's today on Portugal just really highlights how far behind the curve they are.
All right, Greg, thanks for making time for us this morning. Greg Peters,
thanks, Margaret.
Head of Fixed Income there at Morgan Stanley.